Picture this. The trading screens right in front of you are flashing violently red. I mean, everywhere you look, news anchors are frantically reporting on the sudden, catastrophic collapse of century-old banks. Giant, foundational companies are literally declaring bankruptcy overnight, and terrified investors all over the globe are dumping absolutely anything they can get their hands on just to salvage whatever is left. Welcome to this explainer. We are dropping right into the chaos today to figure out exactly what the world's most famous investor was doing while the global economy was seemingly falling apart.
Section 1. Market Panic and the 2008 Crash.
So to really understand Warren Buffett's genius, we have to look back at the extreme panic of 2008. Look, it's incredibly easy to tell a story after you already know the ending, right? We all know Buffett ended up making billions. But what is infinitely harder is understanding a master investor's mindset in those exact hours and days of absolute, blinding fog, when nobody, and I mean nobody, knew if the financial system itself would even survive the week. That is the exact moment paths diverge. In moments of extreme market terror, almost everyone is asking one panicked question: how do I escape? But Buffett, he's sitting calmly in Omaha, asking a completely different question. What excellent assets are on sale because of this panic? That single mental shift during times of extreme uncertainty literally forged one of history's greatest investment careers.
The speed of this collapse is absolutely crucial to remember. September 2008, day one. Lehman Brothers, the titan of Wall Street, declares bankruptcy. Gone. Within a week, global credit freezes entirely solid. Banks simply stopped trusting each other. By the end of the month, corporate funding is ground to a complete halt, and ordinary people are pulling their cash out of everywhere. Even hardened veteran professionals were quietly whispering that we were entering a new Great Depression.
The sheer velocity of the terror was staggering, down 30%. The S&P 500 didn't just decline, it felt like it jumped off a cliff. Every single morning seemed to bring a headline that was somehow worse than the day before. You have to imagine that stomach-dropping sensation of a free fall. That is the exact environment we are talking about here.
Section 2. Buffett's Mindset Amidst Chaos.
Okay, so how do you step out of that heart-pounding panic? Well, Buffett had something most investors didn't. And importantly, it wasn't a crystal ball. He didn't know the future any better than the panic traders sweating on the floor. Instead, he had this specific framing. While the entire market was hyper-fixated on plunging asset prices, Buffett brilliantly ignored the ticker tape entirely. His whole focus was locked on to earnings power, 10 to 20 years out. He was asking himself whether the core problem lay in the momentary price of the asset or in the asset's actual ability to produce profits 2 decades down the line. To him, distinguishing between those two things was everything.
While everyone else was liquidating everything they owned, Buffett was actually taking meetings with executives of major corporations and banks. But, and this is a really vital point, he wasn't meeting them to offer comfort. He was acting as a ruthless diagnostician. He needed to answer one critical question: does the market price reflect true value or blind panic? He was probing to see if a company's problems were just a temporary bruise from the macro environment or a terminal disease. Because, in a panic, the market punishes the exceptional companies right alongside the terrible ones.
Section 3. Crises Deals and the Margin of Safety.
Finding the opportunity is really only half the battle. How you structure the deal when the world is ending is what separates the amateurs from the absolute legends. Let's break down his famous $5 billion lifeline to Goldman Sachs during the absolute peak of the fear in September 2008. People thought he was crazy. Financial institutions were literally the epicenter of the disease. But look at his steps. 1, he didn't just log on to a brokerage and buy regular stock like the rest of us. 2, he negotiated preferred shares. 3, he secured a massive, high fixed yield on those shares. And 4, he gained warrants, which is the right to buy regular stock at a fixed price in the future. Even while buying right in the middle of a historic crisis, he practically engineered the risk right out of the deal. He created a massive margin of safety.
Shortly after, he did it again, pouring billions into General Electric when the market was treating industrial companies like toxic waste. But notice what he did at the exact same time. While he was deploying billions, he simultaneously maintained a fortress of cash. Guys, this is so important. Having cash during a crisis gives you absolute freedom. The investor who drains all their liquidity right before a crash is the one who is forced to sell at the exact bottom. Buffett kept enough cash so he never, ever had to sell out of desperation.
Which leads us to this incredible moment in October 2008. He publishes an op-ed in the New York Times with the title that shocked the financial world: "I am buying American."
The headlines that morning were practically screaming about the apocalypse, and here's Buffett calmly, rationally declaring he's buying. But if you read the fine print, he wasn't predicting a quick recovery at all. He explicitly stated he had absolutely no idea what the market would do in the short term. He was acting purely on long-term value assessment, totally unbothered by the timing of the eventual recovery.
Section 4. The 2020 Shock and Surprising Decisions. Let's fast forward a bit to a totally different type of systemic panic, the 2020 COVID-19 shock. In a matter of weeks, the entire global economy just stopped. Flights grounded, airports empty, restaurants closed, cities entirely emptied out. It was one of the fastest market crashes in human history. The panic was everywhere again. So you'd expect Buffett to run the exact same 2008 playbook, right? No way. In a massive twist, Berkshire Hathaway sold 100% of its holdings in major U.S. airline stocks. He liquidated everything in that sector. Why? Because Buffett's philosophy isn't some rigid, unchanging dogma. He realized that the fundamental structural economics of the airline industry had changed overnight in a way that was literally impossible to forecast. The degree of uncertainty was suddenly way higher than his framework could accept. Value investing doesn't mean holding onto an asset forever if the core assumptions are completely shattered.
And during this 2020 recovery, he was heavily criticized. The Federal Reserve pumped money into the system. The market roared back to life, and Buffett just sat on a mountain of cash, seemingly missing out on a historic buying opportunity. But he was strictly adhering to his ultimate maxim. Rule number 1, never lose money. He much prefers the pain of missing out on a rally over taking a risk he doesn't fully understand. For him, avoiding unquantifiable uncertainty and catastrophic, permanent loss is vastly more important than chasing every single market bounce.
Section 5. The Successful Decision Framework.
So, what does this all mean for us? How did he navigate two historic, terrifying crises without ever needing to accurately predict the future? Well, it all comes down to a highly disciplined decision framework. This right here is his actual crisis rulebook. This is what separates methodical investing from emotional gambling. Ask yourself, can the company still profit in the long run? Is the problem temporary, like a bad quarter, or is it structural, like a global pandemic grounding all flights? Does the entry price offer a margin of safety? And finally, do I have enough cash on hand if things get significantly worse tomorrow?
If the answers to those questions aren't crystal clear, Buffett relies on one incredibly difficult discipline, the immense power of waiting. People think successful investing means constantly moving, acting fast, and trading all day. But actually, often, the greatest investment success lies in the rigorous discipline to just sit on your hands, wait, and have the sheer courage to simply say, I don't know. He didn't know when 2008 would end, and he certainly didn't know how fast 2020 would recover, but he knew his boundaries.
Which leaves us with this final, really critical thought. The ultimate lesson from Buffett's crisis management isn't just about how to extract profits during global terror. It's really about self-control. When the screens turn red again and history promises us they absolutely will you have a framework in place? Or will you let panic dictate your next move? Take some time to think about that and build your own margin of safety.